The stock market has its own wish list when it comes to the budget. Economic growth, positive investor sentiment, and a friendly business environment. This year's budget offers a mixed bag on these fronts. The market was hoping for a fiscally prudent budget with increased capital expenditure and lower taxes on capital gains and personal income. Instead, what we got was a blend of positives, negatives, and neutral elements. One of the more contentious points was the sweeping changes in capital gains tax. In this video, we'll break down how these announcements could impact your equity and mutual fund investments. But first, let's hear what the finance minister had to say.
Short-term gains on certain financial assets shall henceforth attract a tax rate of 20%, while that on all other financial assets and all non-financial assets shall continue to attract the applicable tax rate. Long-term gains on all financial and non-financial assets, on the other hand, will attract a tax rate of 12.5%. For the benefit of the lower and the middle income classes, I propose to increase the limit of exemption of capital gains on certain financial assets to 1.25 lakh rupees per year.
Before the budget, mutual funds had different taxation rules. Some were taxed as long-term or short-term, others at marginal rates, and some enjoyed the concept of indexation. This budget simplifies things by eliminating indexation and streamlining tax categories. Now we have three main categories of taxation. Category 1, equity and mutual funds with more than 65% equity holding. These are taxed as capital assets. Short-term investments, meaning the investments held for less than a year, are taxed at 20%, while long-term investments are taxed at 12.5%. Category 2, funds holding more than 65% in debt securities. These are taxed at slab rates with no distinction between short-term and long-term investments. According to Radhika Gupta, MD and CEO of Edelweiss Mutual Funds, this category remains unchanged from last year. Category 3, funds that don't fit into first two categories such as gold index funds, gold ETFs, funds of funds investing in equities, international funds, and conservative of hybrid funds. Long-term investors in this category benefit from a 12.5% capital gains tax over a 2-year holding period as opposed to the slab rate previously applied. According to Radhika Gupta, this new tax structure is more favorable for long-term investors, particularly those holding diverse portfolios. So what does this mean for you? If you are a long-term investor, these changes might bring some relief, especially if you hold funds in the third category. However, the absence of indexation and the new tax rates could mean a higher tax burden for some investors.